Good afternoon, financial professionals. I'm Phil Haug, Senior Vice President of Sales here at E4 Insurance Services, and I'm welcoming you to the Brew Building Relationships Every Week. Thank you for tuning in today. For those of you who are joining Brew for the very first time, welcome. And we'd like to start today's Brewcast by celebrating today's national days, which today is National Creamsicle Day, which I really don't need another excuse to have ice cream, but I'll take it. And National Financial Awareness Day. So again, my ice cream habit might be coming against my financial goals, but hey, those are sacrifices I'm willing to make. On today's brew, we have Security Mutual Life's retirement service consultant, Armando Testani. He's joining us to answer some burning questions about qualified life insurance and the industry and solutions that they could offer. We encourage you to use the chat box or raise your hands to ask any questions. All attendees will be entered into a drawing for a CE voucher and a Starbucks gift card, and we'll announce our winner at the end. So today we're going to dive in and talk a little bit about how we can use life insurance and qualified plans. And we're going to kind of have a little Q&A session here with Armando. So please, as we're plugging along here, if you have any additional questions, just please put it into the chat box or raise your hand and we'll be happy to call on you. But I guess the first question is, what type of retirement plans can include life insurance?
Well, thanks. I appreciate it, Phil. Thanks for having me as well. And as Phil mentioned, I am Armando Testani. I do work at Security Mutual, and I work in qualified plans. So I'm probably the best person to answer these questions today. Well, one of the best people. Phil's pretty knowledgeable himself too. But answering the question Phil asked, what type of plans can have life insurance in them? All qualified plans, whether it's a 401k plan, a profit sharing plan, a blend of a 401k or profit sharing plan, and then the different types of defined benefit plans, from traditional defined benefit, cash balance plans, as well as 412(e)(3) plans. So as long as the plan document allows for it, life insurance is a permitted investment in all qualified plans. And with most TPA firms, here at Security Mutual, we actually own a TPA firm, Security Administrators. It's as easy as literally just checking a little box in the plan document that says, yes, this plan will allow for the use of life insurance. Mm-hmm. They don't necessarily have to put the life insurance in at that point, but once they check that box, it is a permitted investment in the future if they decide not to do it then. So again, just to wrap that up, all qualified plans, from defined contribution to defined benefit plans, allow for the use of life insurance within them, as long as the plan document allows for it. So that's pretty important. You got to remember that caveat.
So when you're setting,
go ahead.
Oh, so when you're setting up the plan, you have to check the box to make sure that it's eligible to be placed in there.
Correct.
What about if there's an existing plan? Are they able to amend the existing plan documents to include life insurance, or do they have to reestablish a whole new plan?
Good question. Yes, they are allowed to amend the plan document to allow life insurance. When dealing with something like a defined contribution plan, 401k or profit sharing plan, it's relatively easy, because all they'll do is they'll say the plan is going to allow life insurance, and then a portion of the individual's contribution will be allocated to purchase that life insurance. In a defined benefit plan, there's a little bit more work involved, because now they have to redo the plan's formula to allow for the life insurance to be in the plan, because that will impact the plan's contribution levels. But yes, you can just simply amend the plan in order to allow life insurance for a plan that has not had it in it prior.
Okay. You'd referenced it's a permitted investment. Obviously, life insurance is a little bit different category than investment, but is there any specific type of insurance that has to be used in relation to putting it into these qualified plans?
Yes, you have to use a unisex product. Yep. Sex distinct products are really not allowed in qualified plans. I have seen people try to put in sex distinct products if it's an owner only plan and there's no employees. But if you have an employee in there, that's going to blow up in their face. So unisex products are what are required. They can put in a unisex whole life product, or if they choose, they can go with the unisex universal life product as well. As long as the product is universal, they're allowed to put the life insurance in the plan, and it's not a problem. Excuse me, unisex. I apologize. Unisex. Yes.
Unisex. Okay.
Whole life and unisex universal life are permitted in all qualified plans. There is one type of defined benefit plan that does require the use of whole life insurance, and that's the 412(e)(3) plan. and that uses the unisex whole life insurance. But all the other defined benefit and defined contribution plans, you can use either the unisex whole life or the unisex UL product.
So when we're working with Security Mutual to get an illustration or to show this as an example, we need to be sure to denote that it's a unisex plan that's going to be placed into. So when we're requesting the illustration, make sure that that's upfront, right?
Yeah, when actually on our fact finder, it just says, would you like life insurance? Yes or no. So we know automatically, hey, they're looking for a DB plan or a DC plan. We know we're putting unisex products in that plan. And we do offer unisex whole life and unisex UL here at Security Mutual as well. So that's something that will automatically be illustrated to unisex product.
Okay. Just out of curiosity, like what's
Mhm.
the difference? You know, if I took a sex specific versus a unisex, what's the pricing differences? Is it
Well,
pretty close or?
it's close. It'll benefit males, obviously. A unisex product will benefit
Mhm,
male over females. But they're pretty close.
mhm.
You know, they're not much different between the unisex product and the sex distinct product when it comes to the cost.
Okay. So we've got a plan that allows for it. We've got a illustration with a policy that is qualified and works, right? Now, the
Yep.
next question is how do I put that life insurance inside the plan?
Okay, great question. Now, in all qualified plans, as I mentioned earlier, it has to be permitted within the plan document. And then when you're putting it in a defined benefit plan and they decide to use life insurance, whether it's the UL or the whole life, it's going to become part of the formula when we're going to determine what the benefit is at retirement. So say you have a defined benefit plan and you're just using annuities, stocks, or bonds, you're going to have X contribution. When you add that life insurance into the plan, it's actually going to increase the plan's contribution, especially when you're using something like a whole life product, because first year cash value is zero, and then
Mhm.
subsequent years you build that cash value. All these plans, especially defined benefit plans, need to be level funded at the end of the plan. So you have to sock in more money into the plan when putting in life insurance. But it's just as simple as ensuring that plan documents allow for the life insurance and then coming up with a formula that will ensure that the plan will be funded at retirement, because you don't want a plan that will be underfunded or over.
Right.
So that's something we look at all the time with when designing these plans. With a defined contribution plan like a profit sharing or 401k, you really don't have to worry about that, because it's, I'm putting in $50,000 this year.
Mhm.
Great. I'm going to take, 20,000 and put it into my whole life insurance, and 30,000 will go into my mutual funds that I decide to purchase. There are rules when placing life insurance in a qualified plan. We have what's called the incidental death benefit limit. And this is in all qualified plans when it comes to life. What it states is that we can put up to 25% of universal life as the plan's contribution. And we can use up to 50% of the contribution towards whole life. And with defined benefit plans, we have what we call the 100 times rule, which is 100 times the monthly benefit would be the maximum face amount you can get. And then you would solve for what that premium would be. Or we have what we call the 74-307 method. This replicates that 25% and 50% rule. And I would say 99.9% of the plans I design use that 74-307 method, because most of the time it's the client wanting to get as much life insurance as they can.
Mhm.
So up to 25% towards UL and up to 50% towards whole life. So as
Okay.
long as you stay within those parameters, the plan's going to pass testing and it's going to satisfy all of the IRS requirements as well when
And you're
placing life.
when you say those percentages, that's a percentage of contribution.
Correct. A percent of the individual's contribution.
So if I'm putting in 50,000 in your example, I'm using a whole life contract, I can use
Mhm.
25,000 for the whole life contract, 25,000 for my other equities.
Yes.
Okay, cool. So it's obviously a defined benefit or a defined contribution plan. There's an employer that's sponsoring this, right?
Mhm.
But who is paying the premiums on these things?
In defined benefit plans, the owner's paying the premium because contributions come from the owners. So 100% of the time, it's coming from the owner. The owner's making the contribution. The plan itself is the primary beneficiary. So say you're a participant in a DB plan through your employer. So they're going to you're going to get a life policy out of it. So we'll call it E4 Insurance Services Defined Benefit Plan. E4 will be the primary beneficiary on your policy, but you get to name a secondary beneficiary of whomever you choose.
Mhm.
So that what would happen is if anything happened to you, God forbid, the money would go to the plan, the death benefit, and then the plan would distribute it to whomever you decided to have the money go to, whether
Okay.
it is a spouse, a child, a parent, a grandparent, a trust. It could go to anybody, basically. There's been instances where there have been participants who had life insurance and plans, but they had no direct family members. So the benefit went to a charity. So they could do something like that if they choose. But the plan will always be the primary beneficiary. And then they will name a secondary beneficiary. And that's who basically the plan's going to act like a middleman.
Mhm.
They'll get the money and then they'll distribute it to whomever the secondary beneficiary is. In a defined contribution plan, most of the time it's owners making contributions on the employee behalf. Employees can defer into a 401k plan. So they can use some of that money as well to put towards their life insurance, that 25% or 50% limit. So DC plans is a little different. If the employee is not contributing anything to the plan, 100% the owner's making the payments. If they are, they can use some of their deferrals to pay for their premiums as well. But in a DC plan, it's just like a DP plan. The plan is the primary beneficiary, and then they name a secondary beneficiary, and the money will go to that individual.
Okay. Now, silly question. Tax status on the death benefit.
The death benefit is income tax free, less the cash value. So
Okay.
any cash value that's accumulated while the plan has been in place with the life policy, that is taxable. But the
Okay.
death benefit is tax free as long as the person pays their annual PS 58 costs or Table 2001 rates.
So I'm a math brain and somewhat of a visual thinker. So the taxable implicate obviously, like if I have an individual policy and it's $1 million and I pass away, it's subject to my estate, but by and large, it's a tax-free benefit to my
Yes,
beneficiaries.
correct.
In this plan, if I decided to place it into my 401k plan, right?
Mhm.
There's $150,000 worth of cash value in it. There's $1 million death benefit. I pass away, 150 of it is taxable to the beneficiary. The
Correct.
remaining 850 is tax-free.
Correct.
Okay, that's cool.
Mhm.
Very cool. Um, what are the benefits of including life insurance in a plan?
Great question. Um, For employers, benefit of adding life insurance into a plan is another benefit to give employees to kind of keep them safe, especially if you have employees that you like. Um, Owners can use it as a buy sell, especially when there's partners involved. They can use it as key man insurance as well. They put a plan in place, they put a nice policy on their employee in case something happens.
Mhm.
They're covered there. For owners, oftentimes adding life insurance increases the plan's contributions, especially in DB plans specifically. Owners, when they're looking for the max contribution, will get more when they add life insurance to the plan when there is no life insurance to the plan. So oftentimes, if I'll have an agent come to me and say, "Hey, my client wants to sock away as much money as he can. Does he want life insurance?" Well, he doesn't know. If you add life insurance, he'll be able to put away more than if you don't. Great. Let's see the life insurance.
Yeah.
Um, Also, if an individual is rated, what better way to get life insurance than to have Uncle Sam subsidize their life insurance policy because they're using pre-tax dollars for these policies. The owners are also getting a tax benefit. I'm getting life insurance, but I'm also gaining a tax benefit because I'm contributing this to my qualified plan. I get a tax deduction at the end of the year as well. So for employees, like in a defined contribution plan, say a 401k or profit sharing plan, they don't have to necessarily spend extra money out of pocket to buy a life insurance policy, especially if the owner is making contributions on their behalf every year. They could get a little policy for themselves within
Mhm.
defined contribution plan, and they don't have to spend a penny out of pocket for that as well. So, it's some peace of mind for employees as well. So there's a wide variety of reasons from increasing plan contributions, which in turn increases tax benefits for employers, buy-sell agreements, key man insurance, and just for regular rank and file employees, just, a sense of peace of mind for having a policy there just to help in case anything happens while they're employed with this particular employer.
Nice. I've always called life insurance the Swiss Army knife of financial tools, and I can see it has the
Yep,
same benefits in a qualified plan.
absolutely.
Last question,
Mhm.
right? So we just got off of the heels of the quiet quitting, and obviously there, people are, or whatever they called it, right?
Right.
People move around. Got an employee that they happen to leave, right? And
Mhm.
they're no longer part of the group, but they have a plan and they have a life insurance plan inside of it. What happens when the participant leaves the plan?
Great question. There are 5 possible outcomes for when a participant leaves a plan or the plan is terminated. The first possible outcome, well, actually, I apologize. There's 4. There is a 5th, but that's the death of the participant. So they're not,
We don't want to kill them off.
right.
Let's let them
That's
live.
not
Yeah.
ideal for the participants.
Yeah.
If they leave, there's 4 possible outcomes. The first is they simply surrender the policy. The cash value goes into the plan. They can take that lump sum. They could roll it into an IRA if they want, no taxable event at that point, or they can annuitize it and get a benefit, a monthly benefit from that, or they
Mhm.
could just decide to say, I'm taking my lump sum, I'll pay the tax on it, I'm going to retire, I'm going to go buy a boat and live on a lake, or
Mhm.
travel between islands in the Caribbean for the rest of my life. They could do that as well. They can purchase the policy outside of the plan, but when they do that, they have to purchase it for the cash value amount. So that could be a large amount depending on how much cash value they have in the policy at that point. They could sell the policy as well. There are some companies out there that will buy life insurance policies. They could do that. Then the cash value goes into their account as part of the lump sum. And the last is a pretty unique provision we have here at Security Mutual. I believe there's one other country that has something, company.
Company.
Yeah, one other company that has something similar to it. We call it the attained age exchange rider. Basically, the best way to describe it is by giving it an example. Let's say we have a $2 million policy in our plan. And over the years, I've accumulated $500,000 of cash, cash value in the plan. So I'm leaving the plan, but I want to maintain life insurance outside of the plan. What you could do with this unique provision here at Security Mutual is we'll take that old death benefit you have, $2 million. We'll say your max face amount that you can purchase outside of the plan for a brand new policy outside of the plan will be 1.5 million because you've accumulated 500,000 of cash value. So that's the max policy you can buy outside of the plan. It doesn't even have to be the same type of policy you had previously. You want to buy a UL policy? Great. You want to buy a 10 pay? You could structure it however you want, whole life, whatever you want. We're going to then issue that $1.5 million death benefit. That would be the max. So if they only wanted a million, they could do a million. But we're going to issue it at whatever class the individual was when they took out the original policy. So say it was 10 years ago.
Yep.
We're going to issue it at whatever that person was 10 years ago. They were a standard non-smoker, it's still going to be a standard non-smoker. There's no underwriting involved. But say you were a standard non-smoker 10 years ago, you developed diabetes, you let it get out of control, now you'd be table 2 or table 3. Guess what? You're still getting a
Standard non-smoker.
non-smoker policy outside of the plan. No underwriting. It's essentially like a guaranteed issue product, but you're going to pay premiums at whatever attained age you are at that point. So if you took it out at 50, now you're 60, you're going to pay premiums for that policy of a 60-year-old, but you don't have to go through any underwriting.
But it's a fixed premium too. It pertains the provisions of an individual contract. Is that correct?
It's up. So the maximum would be up to the 1.5 million in this instance. They don't have to go that high if they don't want to.
No, I mean like it's not
Oh yeah,
it's not
it's
like
a
an
permanent
annual
policy.
renewable. Gotcha.
Yep. Yep. But they could structure it if they have enough money, in their side fund or whatever, that they want to do a 5 pay or 10 pay, they could structure it like that as well. They could structure the policy however they want because it is a brand new policy outside of the plan. The only difference is we're not going to have you go through underwriting because we're going to issue it at whatever you were when you took out that original policy. You'll pay the premiums at that attained age. but we're going to issue it at whatever you were 10 years ago, 12, 15 years ago. Brand new policy, fully
Nice.
commissionable for agents as well, because it's a brand new
Nice.
policy.
But no underwriting.
Yep, no
Not that
wonder.
we don't, not that we don't like our underwriters, but it's nice when we don't have to involve them, right?
Exactly. And that's
Perfect.
pretty popular. I've seen that used quite a bit with a lot of our agents when they have individuals that are coming to termination from the plan, or the plan is just shutting
So other than the consistency of life insurance, the maintaining a tax-free death benefit, uh, getting some growth inside a contract, having the ability to have the owners and officers contribute more. Is there anything I'm missing on? And then guaranteed insurability after the exiting of the plan.
down.
Is there anything I'm missing on why we wouldn't want to do this?
Uh, Not really. I mean, for businesses, it's a great tool. Plus, in most situations, life insurance is exempt from creditors as well. Creditors can't come after it, so that's another nice feature for a business owner. But I think we've really hammered the nail on a lot of the features and the benefits of why purchasing life insurance in a qualified plan makes sense.
Yeah, no, for sure. Well, I appreciate it very, very much.
You're very welcome. It's my pleasure.
While we wait for additional questions, I'd like to remind you that today's brew and our full library are recorded and are always shared on our brew page at our website of www.e4.insurance. And today's page will also be sending out on the newsletter a link with more information on this as well. So, and for our giveaway, Armando, I'd like you to pick a number between 1 and 24.
Let's go with number 19.
19. Our winner is Kelly. So Kelly is going to be on the lookout for a, Starbucks gift card, and it'll be coming your way, and CE, and it'll be on your way from all of us here at E4 Insurance Services. Before we wrap up, if there's any additional questions or any raised hands, I want to say thank you to Armando for investing some time and being a strategic partner with us here at E4. Things are obviously, this is a great topic that we can bring to our advisors and our team, is it's an alternative solution that a lot of people have really good questions, and now I've got some additional answers for them. So do you work with business owners looking to maximize tax deductions or diversified savings ideas? Then you do not want to miss next week's brew with Bill Anderson, our wealth strategist, who will share real life examples of how business owners are doing that in the market today. I want to thank everybody for investing time today, and we look forward to seeing you on next week's brew. And Armando, thank you very much.
Thanks. It was my pleasure.
Appreciate
Take
it.
care, everybody.